Should you put crypto in your retirement account? That's the million-dollar question, and after August 2025, the answer might not even be up to you. A new executive order opened the door for 401k plans to hold crypto ETFs, which means your target date fund could already have Bitcoin exposure right now. So the real question isn't should crypto touch your retirement, it's how much and what's the smartest way to manage it. Today we'll decode crypto's role in retirement, break down the biggest risks, and give you a clear playbook to protect your future. Section 1. The Volatility Trap. Let's start with the obvious. Volatility. Bitcoin's average daily swings are often triple those of the S&P 500. In 2022, it lost 65% of its value in just 8 months. Imagine that inside a retirement portfolio. For someone 2 years away from retiring, even a 5% crypto allocation could feel like a 20% hit on the entire nest egg. That's the difference between funding a grandchild's tuition or delaying your retirement plans. The solution? Position sizing. Studies from Yale and Cambridge show that a 1 to 3% allocation can improve risk-adjusted returns because crypto often moves independently of traditional markets. But once you creep above 5%, the risk outweighs the benefit. Quick example. If your 401k has $400,000, keep crypto exposure under $20,000. Rebalance once a year to stay disciplined. Don't let emotions or CNBC headlines drive your decisions. Section 2. The Security Blind Spot. Now, let's talk about security. Unlike your FDIC-insured bank account, crypto theft is irreversible. In 2024 alone, hackers stole over $1.7 billion in digital assets. Inside your employer plan, a custodian manages the risk with institutional-grade safeguards. But if you roll assets into a self-directed IRA or buy crypto directly, the responsibility falls on you. One phishing link, one stolen private key, and it's gone. Best practice for retirement savings. Stick to regulated vehicles, crypto, ETFs, or funds like Fidelity's Crypto Index. These use cold storage, multi-signature protection, and SEC oversight. If you insist on holding coins directly, cap it at 1% of your liquid net worth and use a hardware wallet. Store recovery phrases in multiple secure locations. Think of it as building your own mini Fort Knox. Section 3. The FOMO fallacy. But the biggest threat isn't hackers or volatility, it's your own brain. The fear of missing out, or FOMO, kills retirement strategies. FINRA research shows investors who check crypto prices daily end up with 40% lower lifetime returns than those who check quarterly. Why? Because constant checking leads to buying high in greed and selling low in panic. The antidote? Automation. Set payroll deductions to dollar cost average into your chosen fund. Automate rebalancing with a 5% trigger up or down. Mute the push notifications and influencer noise. This is how you remove emotion and build discipline. Retirement investing should be boring, not a 24/7 adrenaline rush. If this breakdown is helping you rethink your allocation, hit that subscribe button. I post simple, proven strategies to protect and grow your money. And drop a comment below. Does your 401k already hold crypto? If so, how much? I'd love to hear your take. Section 4. Regulatory Reality Check. So, where does the law stand? The Department of Labor now allows 401k plans to offer crypto exposure, but only through SEC-regulated products. That means your HR department has a fiduciary duty to protect you. They can cut crypto options if fees spike or risks grow. Congress is also debating a retirement crypto oversight bill that could require quarterly disclosures and third-party audits. Bottom line, don't expect to buy random altcoins in your 401k. Exposure will stay institutional and regulated. Section 5. Putting it together. So, how do you apply this to your retirement plan? Here's the playbook. 1. Audit your exposure. Log into your 401k and search terms like digital asset or crypto ETF. You may already own some. 2. Set an allocation ceiling. For most, 1 to 3% is plenty. Only the most risk-tolerant should ever consider 5%. 3. Automate contributions and rebalance yearly. Take emotions out of the process. 4. Secure direct holdings. If you own coins yourself, use a hardware wallet and secure seed phrases. 5. Write down your plan. Share it with a spouse or heir so there's no confusion during market chaos. Crypto isn't magic fairy dust, and it isn't poison either. It's a high-octane asset class. A little can diversify your retirement portfolio, but too much can wreck it. So, remember, manage volatility with small allocations. Protect against hacks with regulated custodians. Beat FOMO with automation and discipline. Do that, and you'll capture crypto's upside while still protecting the secure retirement you work for. If you found value in this video, share it with a friend who thinks Bitcoin is a retirement plan. And check out my next video on the best low-fee ETFs for retirement. It's linked right here. Until next time, stay smart, stay disciplined, and let your money move the right way.